Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, April 17th, 2020. What I'm going to do in this video is cover some of the trade ideas on the site, both official and unofficial trades. A couple new ones here for you as well. We'll start out here with KHC. I'm trying, well, actually, I'm not trying as hard as I should. I need to work a little harder at sharing some bullish trade setups that might contradict or not align with my current views on where the market's headed. For those of you that are looking for trade ideas or are bullish and or a little of both, and this is one of them. I flagged this one the other day. Even did I mark up targets? I was considering posting it as a trade setup. I'll share my thoughts. This is KHC. Now, KHC has had its share of problems in recent years, and that a lot of that's reflected in the stock. Already being in a bear market. This stock peaked back in early 2017 and has already dropped quite a bit from there. And let's see, it's had a bear market of about 80% so far. 80% of its value wiped out. Number one is this guy, and like everything else that got caught in COVID, I'd like to think maybe the worst is priced into this stock already, and it's actually shown some nice relative strength recently. So what I just did, I flipped to a weekly chart. Sometimes I forget to mention that. If I do, you can see right up here, you can see the ticker symbol and the time frame we're working off of. Scaling is down here, so you can see when I'm on a weekly chart, I'm usually going back many years, and that's what we're looking at here. So there's your year break lines. It's just it's a clean chart. Now I'm going to give you my thoughts on it. So why I'm not buying it right now. I'll keep an eye. Maybe I'll take some of this later as a hedge in my accounts. But I think it probably needs another thrust down below this trend line. It's spent a lot of energy, expended a lot of energy to run up from the bottom to the top here. It, like everything else, got caught in the recent sell-off. But again, it already been in a bear market, so it's already beat down. In other words, here's a stock that's probably not nearly as overvalued as most companies out there. Larger brand name company. It still has a lot of goodwill, and it rallied about 48%, almost 50% off the lows recently. But again, you remember that when you lose 50% on a stock, you have to then make not 50% to get back to where you were. You have to make 100%. So like right here. So that's how the math works. It's very cruel to those that allow losses to get out of hand. There's a 50% drop, so when KHC went down from about 100 to 50. Remember, it's then got to go from 50 to 100, which is a double. You got to make 100%. And so when you drop as much as it did now, the 80% or so drop to get back to where it was, you don't have to make 80%. You don't have to make 160%. You have to then make 390%. That's how the math works. So, in other words, don't get tied up in these 50% rally. Oh my gosh, that's so powerful, so bullish. It's just the nature of a volatile market and a stock that's beat down. And when you look at this chart, it doesn't look any different than a setup I might find on a 15 or 60-minute chart. With this, the key is the downtrend line, and everything kind of goes into perspective. It's a weekly chart, so if and when we break out of this pattern, you have strong multi-year, year and a half or year plus divergent, nice positive divergences here on the weekly chart, and you can see my targets. You have the big 40-week exponential moving average, which is also the same. This red line here is a 200-day. On many stocks and indexes, it does a good job of defining bull and bear markets, bull and bear trends. When you're above it, you're in a bull trend. When you cross down below it, you've entered a bear market, and then that level, that moving average, acts as resistance on back tests. So that's what's capping it right now, and that's what I like it even more so, because I have not one but two well-watched levels. There's some traders that might only look at the 200-day EMA or 40-week, on a weekly chart it's a 40 period, and others might be looking at the trend line. And I like to see when a trade has not one but two, and even better if you can find three well-watched resistance levels, because that would trigger a breakout that more traders would come in at. In other words, some traders buying the breakout above the trend line, some buying the breakout above the 40-week moving average, and etc. So that's it. You can see first target up here is about 33.37. It's a dividend-paying stock, kicking out a nice yield. I don't know how secure that is, but it's about 5.5% dividend yield right now. Actually, I think I read on another site it was about 5.6, the forward-looking dividend. and then about 15% or so capital appreciation to that first target there. But again, my gut is that based on my, aligning this with my views on the broad market and the fact that it's expended a lot of energy, again, 50% just to get back up to that, test that trend line again. Anything is possible. It could certainly break out and run, but chances are it'll need to work off some of those near-term overbought conditions. So we'll keep an eye on this one. In other words, you might want to buy it, pull back at lower levels. If you see any kind of objective entry, I wouldn't at this point right now. Again, I just want to pass it along, and you can see on the daily chart too here we have bullish divergence. We had a divergent low here, and it's not as if it didn't work. It was a small divergent low, led to a small bear market rally of about 19%. We had another divergent low right here, a bigger divergent low, and this is what I talk about a lot, and led to a 35% rally. And this is all one and the same divergence. It's just an extension. Little divergent low, little rally. Same divergence, but extended larger rally. Rally 1, rally 2. And now the same divergence starting from this point, generating here with the RSI and PPO making a series of higher highs. And so far, that divergent low was good for a 50% rally. And ultimately, if we can break out, you can see this is a big level, by the way. So if you break out, I'd expect to run up to about that 30. You can see all the levels marked, but about 3361. Maybe consolidate a little there. Who knows? Maybe it's a year away before this thing breaks out. One potential scenario here, and I like to look ahead at things and just say it's a potential scenario, would be this inverse head and shoulders bottoming pattern. I love those. They're nice patterns to watch. You have a left shoulder, what could be the formation of a head right here. If you run up, you get a head form. Let's say you then break out above this trend line, run up to that 3361 level, which is also called the neckline on the pattern, head and shoulders pattern. This is your right shoulder here. Trying to draw with a line tool, not so easy. This is your head. And then if you, I'm sorry, I'm a little dyslexic here. That'd be your left shoulder, of course. Blur that out, and this would be your right shoulder over here, okay? And then a breakout. So again, I throw these things out there, and I may not bring up KHC ever again. I might not bring it up for a few more months, but because the thing is, I throw out so many trade ideas, some fall through the cracks, and I don't follow up on those. So there it is. There's an idea for you in levels to watch. I can't guarantee. And the head and shoulders or inverse head and shoulders is only one potential pattern of many, but one to watch. And again, point being, and it would take a few months. Those patterns are, by the way, they're best formed over a series of weeks or even months, and that would fit the bill here. And so to kind of continue on what I was saying, and you can look up, do a Google search on inverse head and shoulders patterns. You'll see all about them. The measured target is the distance from the bottom of the head up to the neckline, added to where it breaks out of the pattern. So that would project quite a ways up here, maybe all the way up to that highest target that I have, 5462. But at the very least, you have a big old gap right here to be backfilled. And actually, technically speaking, the gap goes all the way up there, but to right here to that 4815 target, because that's where we gap down. So there's your gap right there, but there is a major reaction low there. So you'd probably have a hiccup here along the way. And again, one of many, but I wanted to kind of try to balance out the trade ideas. And then that rolls into the updates that I want to do. Let's cover our active trades, and then I'll show you a few more unofficial trades. So these are the official trades. Here's Berkshire. I'm going to move this over here. Berkshire is based off the weekly chart. The whole premise of this trade is that we've rallied back into very significant resistance here, 196.28. You can see all the reactions there, and nothing's changed. So it's based off the weekly chart, so I'm not going to do very frequent updates on a trade like this. We're well below the stop, well above our price targets. Where am I missing one here? I don't know what's going on. That's odd. There should be one more price target in there. Maybe I did T1. Maybe I meant to say T1, T2. Let me take a quick look at the original chart I posted. Okay, that's odd. Well, there it is. T1 162.85, T2 151.77, also on the charts there. Sometimes I'll use different boards. Either way, I think you can see that. Let's just fix that real quick. It just looks like a little typo, and we'll move on to the next one because there's really not much more to talk about this. So far, it's stalled out where quote unquote it should have or were expected to. Big divergences, and again, weekly charts take trades based off the weekly chart typically take minimum of many weeks, or several weeks, or many months to play out, sometimes even years. But in this market, bear markets tend to unwind and develop and play out faster than bull markets. I always say one reason I love shorting is stocks tend to drop a lot faster than they fall. So your average bear market runs about 18 months. Your average bull market up until this one's going to skew the averages, but I've seen numbers anywhere around 5.5 years, give or take, on an average bull market duration. Okay, and in no particular order, we'll just go through these alphabetically. Corn. Corn's just a way to diversify. It's up 1.4% today, and still needs. The big thing is the futures. We can look at this chart here. We'll look at the 60-minute chart. You can watch that. You do have a downtrend working its way. Corn working its way down here within this bullish falling wedge pattern. We just kind of need that catalyst. We need it to break out, and then really you want to watch corn futures ZC, and you can see there's a downtrend. I may have revised this downtrend since I had it back down here. Maybe a little whipsaw signal, but I think this is the best fit right now, because we come in, we capture all these highs back here, reaction highs, and then that recent reaction high there, and we hit it again. So there it is. There's your falling wedge pattern. Need a breakout, and I may have had to update this chart. That's one thing with this charting program from time to time. The futures contracts roll, and then I have to they stop populating that chart, and they roll to the next one. We're on the July futures right now for ZC corn, and just adding back, probably these should have been some of the levels. Even if not, I could just look at this chart and tell you right now these are some potential targets if and when corn futures can break out and giddy up and get going. So if they break out anytime soon, you're going to run into resistance here about 337. That'll be your first target. And then probably get a reaction there, power through there, break out above there. Should bring you up to these other targets. Next up, Costco seemed to be a crowd favorite in last night's post. A lot of ranting and raving about how good a company it is and just increase their dividends. And look, here's the thing: like any trade, it's either going to work out or not. I don't have any more into this trade than I would any other one. Spread your eggs, don't put them all in one basket. But the same basis for the trade that was made originally, we're still above. It's a long-term trade. This is again based off the weekly charts. Not many of the trade ideas, the majority of the trade ideas on the site are based off anywhere from the 60-minute to daily charts. And the longer the term time frame of the chart, the longer the holding period, expected holding period, and the bigger the move for the trade as well. So we have very large downside targets. Nothing's changed really technically. We did check out that minor downtrend line on the daily chart. It's come up a little bit, but again, we're still, when I look at this weekly chart, we're comfortably above the stop, and we still need to take out this uptrend line. That would be a powerful sell signal, and then just below that's our first target, set just above the 282 support. But again, I've already stated my fundamental and technical basis for that trade, and as of now, I don't see any reason to change it. Okay, gold's come under some selling pressure recently. This is an active trade, and really no surprise. We did have a breakout recently, but as I started warning back earlier this week, when was it? About on the 9th. Actually, it's been over a week now. Here, let's look at those charts. We have this one back on. That's not centered, is it? Nope, you can't see that. There it is. Back on April 9th. Started warning. Look, we broke out. But the problem with the breakout, and why I started to lay out alternative scenarios here, is we had negative divergence, and I said, breakouts that occur with negative divergence and overbought conditions typically fail. On the flip side, gold is or was and still is in a larger term bull market. So, I don't expect a lot more downside. You can see the, potential target if we fail, or if we failed, which we have. We failed the breakout already since then. So I said bearish case, negative divergence in place. So a failure to hold the breakout, which is this level, 1728, especially a break back down below the uptrend line. So that's sell signal number 1 right here. If and when we got it, which we did. Sell signal number 2 was a break of this uptrend line, would signal a bull trap false breakout. And that's a pretty bearish thing. When you have a failed breakout, called a bull trap, bulls pile in. And so that was then, I added another chart, a follow-up. That was also on that was on the 13th, saying, look, Friday's breakout, blah blah blah, is at risk of failing if these negative divergences play out. And then finally, we had this one here. Need to center it so you can see it. Gold breakdown and back test at the 60-minute wedge. We broke that trend line, back tested there. Look, so pretty much that's how it works. If we break that minor trend line, which we did, boom, we had a chance to hold that primary trend line. And it's, again, this was on April 16th, but we didn't. So this is why this is the correction in gold. So again, not what I wanted to see with it being a long-term trade, but nothing. This is a correction, I think, within a bull market. And again, it was, all these levels were telegraphed in advance what would happen if you wanted to short it, or if you did, congratulations to you. That was here's the steps that happened. We had the failure of the breakout level. We had the little wedge break, then the bigger trend line break, then we had a minor trend line, a back test of the wedge, breakdown, back test, and here we go. And there's not a lot of support. I will add there's a little bit of support right about where we are now, and there's that 1673 target that I laid out over a week ago if this breakout failed, which it has now since done. So the stock market's rallying, of course, which puts extra pressure on gold, being a flight to safety asset. So that's it. So again, where am I going with this? Well, that's just near-term stuff. I may be a little more downside in gold, but it's still in a longer-term bull market. And let me add right now, kind of what I'm seeing here is a potential trend line coming off the lows, give or take, right there, and that's starting to crack as well. So again, that minor support here, and at this point, if you were going to short gold, you had 1, 2, 3. Several shorting ops. It's not objective anymore. Could certainly go lower, but I see minimal downside unless the market happens to continue to rally next week. That's certainly a possibility. It's not what I'm leaning towards, but if that happens, you can see all the levels here, potential targets on gold, including that 1673 target I laid out over a week ago there. And this is something I've been watching, and it's a little concerning too. Tell me not to get married to this one trade, even though I have a longer term target up here about 174 on gold, GLD, the ETF. This is a weekly chart, and we have negative divergences out here on the weekly time frame, just like we had negative divergences here. Remember, we're in a bull market, and we had negative divergence here. And so even in a bull market, I mean, you don't want to ride out a full a divergent high on the weekly. Remember, we're not talking a 60-minute chart. If we were, which we were a second ago on GC Gold Futures, you're talking relatively small pullback. But there's a little doji candlestick so far, potential divergence. I just want to point this out that it's if nothing else, maybe a good time to tighten up stops for longer term traders, and maybe not add aggressively on pullbacks if you have been buying pullbacks in gold in this bull market. Let's see what the daily chart looks like. The daily chart's okay because we've taken out the divergence right here. Well, that weekly divergence would really span back from here to here, about equal highs right there. But you have the RSI divergence, but again, you don't have the PPO divergence, and you are in a bull market, so you give this maybe a little bit less a weighting than you would if you weren't in a bull market. But there's a trend line there on GLD to watch, and that's it. So where this goes, I'll just tell you real quick. If the stock market can somehow power through these current divergences and fail to give us those sell signals that we're still dancing right on it on QQQ. Remember, I did a video earlier today. QQQ and the NASDAQ 100 is sitting right around, or QQQ is starting to crack this trend line. It's all about tech right now. Tech has, again, been rallying, and everybody thinks tech is bulletproof through this whole thing. I beg to differ from a fundamental perspective, but maybe I'll be the I'll be the one wrong, and the masses will be right. But there it is. We have a little minor support here, about 87.16. Again, I didn't want to do too much on the broad markets, but it has to do with where I think gold goes. So if we can get a little more downside, maybe a nice dump into the close today, and especially a follow through. I hate late Friday breakdowns because they tend to be, you're heading into the weekend, you just can't put as much of a stock into a breakout or a breakdown that occurs, in the last hour of trading on a Friday, because you could get people that are squaring out their positions for the weekend, maybe closing out longs, taking profits, things like that. However, with that being said, although I won't maybe give it as high as a weighting if it occurred midweek, midday, you have to take the charts for what they are, and a breakdown is a breakdown. So while it might not be, as good of a sell signal as if you get it on, mid-session, midweek, we'll see what happens today. And this is what we need to see in NQ. If this happens, that sell signal I'm looking for opens the door for a move down like I'm looking for, and therefore gold could, and I've seen this many times in a bull market, could abruptly reverse. And you can look at it this way: 60-minute breakdown right here, 60-minute divergence, and maybe that divergence is now played out. Especially in a bull market, these divergences and these bullish or bearish patterns in a bull market tend to play out for much lower moves than they do in a bear market. You get a rising wedge in a bear market, you're looking at the next leg down often. Just like in a bull market, you get these little bullish falling wedges for the last year or so in the S&P 500 or NASDAQ. You get these corrections and they set up in little 60-minute bullish falling wedges, and they open the door not for the measured move, which is the widest part of the wedge, but they for years now open the door to the next leg up in the bull market. So that's where I'm kind of leaning towards with gold. Okay, hope it didn't confuse you there. Throwing a lot of arrows out there, and at the end of the day, I have to recognize, I'll either be right or wrong on my call in the markets, and so it most likely will impact, where gold goes. And next up on the list, that's LQD. Let's go to the chart of LQD here. I already told you this is where the Fed focus most of their effort. They don't come in and aggressively buy stocks. The Fed, to support the stock market, they simply need to, prevent, financial Armageddon. They simply need to shore up the credit markets. And if you shore up the credit markets, then at least it's a, a tremendous help for the stock markets. That's what they did. So most of their money and efforts were thrown at this and other parts of the credit market. And that's everything that I had outlined for the reason, for the basis of those last two shorts. So far, I revised the stop, so technically we're not 2 for 3 yet. We're 2 for 2 right now in closed trades. We shorted LQD there. We covered that short right here before the big bounce. We sidestepped the profit give back. The second trade, we shorted it somewhere in there. Then we covered wherever it was, can't recall, down here or down here or here. And we sidestepped most of the give back. Then we shorted again right here at 122.77. Went underwater. I pulled the stop one day because it was a beautiful, without the Fed in the game, this would be, I can say it with convictions, a 10 on a scale 1 to 10 for a beautiful shorting op. You had a breakdown of a very well-defined trend line right there, rising wedge pattern. You had an initial leg down, a kickback rally to come in and back test it, a perfect back test. That was the day I pulled the stops for one day, said let's just, worst case scenario, we'll reinstate it, and it holds true right now, 135, 130, 135. You can do what you want. I've spoken to this trade many times. The Fed can throw, and they have everything that they have at this to shore up the credit bond markets, but I still think there's minimal upside, just like the stock market. They prevented a major collapse, which would have potentially led to a seize up in the credit markets. But I still think they're not going to. You're still talking. There's a huge mess in the corporate bond market, and the Fed can't stop it all. And that is the economy shutting down. So all those companies that had a marginal credit rating of BBB, which is the largest issuance of BBB debt we've ever seen, it happened in the last few years, they're still BBB. Whether or not the Fed has convinced the rating agencies to give them a stay of execution doesn't matter, because even if they get downgraded, the Fed said they're going to buy those. They're going to buy LQD. The first day they came out and said they invoked emergency charter to allow them to come in and buy low-grade bonds, junk bonds. They bought Ford's bonds, which got downgraded to junk status, and of course they can even buy ETFs directly, such as this one. But they're not stupid. They're not going to burn up all their capital. They have very, very few arrows left in their quiver, and there's no reason to take corporate bonds back to where they were above, because right now, fundamentally, if the Fed wasn't in the market, the corporate bonds would be way down here. And so I think they overdid it. Most of this, by the way, was short covering. Caught everyone off guard that day. They came in and said they were going to prop up the investment, the corporate bond market, and so the shorts are finally mostly probably squeezed out, and I think we'll come back down to a reasonable level here. And again, they pop it. You do what you want. You might want to give it a little more room on the stop. But we'll probably not anytime soon at least get down to that second target. So I may revise this trade. I just wanted to say and close it out early, whether we backfill there, hit T1. Let's just say right now, I probably wouldn't short it if I wasn't already short LQD, because of the fact again that the Fed's really zeroing in on this, their efforts right now, and so they're not gonna. Who knows? Maybe it can get down there. Market forces, I believe, ultimately are going to be more powerful than the Fed. There's too much money in the bond market for the Fed to completely shore it up, but a lot of that has to do with how quick the economy comes back online. So there is a wild card. I'm not going to sit here and tell you definitively I know where corporate bonds are going and what's going to happen, but I can tell you that a lot of where we go from here will be there. And once the Fed starts to taper out of this, they're eventually going to have to let market forces run their course and price these bonds where they need to be. That'll be the interesting part. How in the heck the Fed gets out of they're all in right now, and how they exit this. And so again, I see a limited ceiling for years, at least the next year or so in corporate bonds. And you can stay short. The problem with being short for a long time, you pay the dividend. The dividend isn't a whole lot on this one, but when you're short a stock or an ETF, you have to pay the dividend when it comes out instead of collecting it like when you're long. Next up, PALL. I still very, very much like this trade. This is not something the Fed's going to come in and save. There's no vested interest for them to save palladium prices. I am, to be honest, a bit perplexed. No, let's take that back. The stock market rally, like I said, that was foreseen. We went long the financials the day after the stock market bottomed. That was one of our long trades. That was clearly showing only long side upside targets on the stock market. So the stock market bounce, as I covered earlier today, was expected. We exceeded my uppermost bounce target in the SPY of 20% by an additional 5%. Market rallied 25, where I figured we might see as much as a 20% bounce. So now, and of course, Palladium is more, as I said, initially, an economic or fundamental play on the economy as much as anything else. Huge profit potential, I think, in this one. T3, I think that will be exceeded over time, and I may add additional targets. But what's going on here? This whole trade was based on this. The big demand, there was been a shortage of palladium, and it is used in emissions control for trucks and auto vehicles, cars and trucks. And we can go back over time, and you can see this is the auto vehicle sales. The shaded gray area is a recession. I mean, it's that simple. When the economy goes into recession, auto sales then plummet, and they turn down ahead of time. You see the gray lines, because you're not seeing gray lines here. We're in a recession right now, make no mistake about it. The only thing is, it won't be official until you can go back after 2 quarters are over. You need 2 quarters of contracting GDP growth. Quarter is 3 months, so you're talking 6 months. You have to have those 2 quarters back to back, and then GDP comes out a month after the quarter's over, and then you're going to hear from the government that's official. But and that's why you see these turn downs, and then boom, the recession comes. So this is it. Vehicle sales peak. They usually peak. If you look at, there's a few aberrations on the chart, meaning these spikes right here. These are just aberration volatility, but you can see back in the 80s and 90s, this is about the level. About 16 million units were light truck and auto sales peaked. Then in the 2000s and modern history, this has been about our ceiling right here. Again, back out those brief aberrations. It probably had to do with just the way the numbers were measured. Maybe they lagged behind the previous month. So these are just little errant spikes. But you can see if you kind of put let's say a moving average on here, you'd see the line coming through the middle right here, and again, that's where we peaked, and that's where we peaked again. And so the cycle is turned down. This is not an aberration or anything like this. This is auto sales falling off a cliff. The start of one of the worst drops that we've seen in a long time. And if you're bullish and you think we're going to get right back in dealerships and lots, they're going to be selling cars in a few months like they were a year ago, buy with everything you have. Go in, buy Ford, General Motors. If you think this is the start of this and leading in, because here's the thing I'm trying to, once the economy turns, once the business cycle turns, that's it. And then it's a self-fulfilling prophecy. It's more of a vicious cycle. People lose their job, they get laid off. Then business owners see that they're worried about things, they peel back in. So even if coronavirus goes away, you're still going to have business owners reluctant to hire, big corporations reluctant to expand, take on new projects. Ford may second guess opening that new auto plant in Mexico or Detroit or wherever they're going to open it, and so forth and so on. And that's how the ship has turned. And so therefore, where am I going with this? Palladium. And Palladium, I've done a video dedicated to only Palladium, and I've showed you that the cycles which ebb and flow with auto sales and the economy, when Palladium finally tops, you're talking bear markets in almost every single economic downturn, every turn of the business cycle, meaning a recession or economic contraction. You're talking drops of 70 to 80% in Palladium prices. And so the fact it's holding up here, unless I'm wrong and this market just blasts off to new highs and continues to go over the next year or so, and auto sales all of a sudden get back on track, then yeah, there's going to be more demand for Palladium. Otherwise, you'll probably see Palladium prices collapse soon. As such, I still think it's an objective entry. We shorted it on a break below 207. It's at 205.49, so we're slightly profitable. And I still think it offers an objective long or short entry. I'm sorry. Now, and what's going to be the catalyst? Fundamentals can take a long time to play out. That's the problem with trading fundamentals. You want to nail the timing. This is it. I've been talking about this trend line right here. This goes all the way back here for quite some time in Palladium futures. And we had, during the meltdown, there was a lot of forced selling, liquidations. Just about everything fell due to that unwinding of the excessive margin and everything else. Institutions and individuals sold what they had, and if they didn't want to sell it, guess what? Their broker came in and sold it for them via margin calls. And so that's why you had that swift move down, and you had a swift move back, carried it back above the trend line. A lot of momentum fueled overshoots there. Back tested that trend line here, and we've been dancing right here on this trend line. So we need this trend line to go once again, and that should open the door for the next leg down in Palladium. And these are Palladium futures, PA. Next up, SGG is an official trade. That's a sugar ETN. We entered that at 32.92, so right about there somewhere. We're up a little bit. Nothing to write home about right now, but I like it. And again, it's just a way to diversify and spread your eggs amongst different baskets. This is a 60-minute chart, but really what you want to look at more so than this ETN that's attempting to track sugars. You want to look at sugar futures. Those are symbol SB. I've got it somewhere here. Here we go. SB. Need to refresh this one. That's it. So you can see it firming up. It's a nice looking chart. You have a 60-minute chart here. You had a divergent low right here. The divergence was extended. You had a double bottom. So while prices made an equal low, you had the indicators continuing to make higher lows. That's an extension of the positive, aka bullish divergence. We had the primary trend line right here, which we had a breakout and a back test recently, successful back test, and we've been moving higher since. We also recently took out this secondary or minor trend line, big level here, 1081 right there needs to be popped. You have this little, consolidation range. We're building energy, and if sugar can pop that, it should be a quick move up to any or all of these targets right there. Next one up is SPY, the S&P 500. That's an official trade. Really kind of just moving around here sideways for the last couple days, last several days, last week or so really. Below the stop number 2, the maximum stop on a daily close above 286.08. But we still need to take this trend line to get things going. So we'll see. There's an hour and 15 minutes left in the trading day, in the trading week. We'll see where we close. If we get close to that level, I'll make a decision whether to officially, pull the stop today or not. I'll just tell you right now, there's nothing that I could see SPY doing that would shake me out of, any of my swing short positions, including, this one. Anything that it does today into the close. Any late day ramp would just be order imbalances, people buying into the weekend, and again, it's not going to change much on the long-term charts, or really even on this 60-minute chart, because it would be almost impossible to see SPY take out the bullish divergences today. Because even if I, take this, they're starting to get a little steeper here. But even if I move this trend line up, there's plenty of room for the PPO and the RSI to come up and still keep the divergences in this, potential bearish setup intact for now. So that's SPY. And next up would be SSG. Oh no, that one was already stopped out. I mentioned that the other day. I just need to get on and post an update. So that's officially stopped out, but I just gave you my thoughts there. It's still, I think that's semis have a lot of potential. And then Verizon. VZ, also based off the weekly chart, looking long term on this one, nothing's changed technically. Ran into this downtrend line the other day when we shorted it. We're still there. Failed attempt intra-week to get above there. Looks like we're going to print a weekly close right on there. So it's a second test of that trend line, and we also intra-week back tested the other uptrend line from below there, and that's it. So nothing more to add. It's really the same technical posture and basis for shorting this one earlier this week. It's still intact as of now. Okay, I have a couple more unofficial trade ideas I'll update, like natural gas I shared in the trading room yesterday. Let's just go through these. So today, and it's just talking about diversification. Berkshire is a short and it's up, so we're down. Corn is a long trade, so we're up. There's a check mark. Costco is a short and it's down, so we're up. Gold is a long and it's down. LQD is a short, basically flat, but it's red. Palladium is a short, so that one doesn't work out. Sugar's a long. SPY is a short. Semis we've already closed out. Just need to update that. And Verizon is a short, so no dice. So we've got 1, 2, 3, 4 check marks against 1, 2, 3, 4, 5 X's. Again, just part of being diversified. Helps to smooth out the bumps and on up and down days. Okay, let's look at NG natural gas. It was traded posted as a trade idea in the trading room yesterday. Posted the other day here as a potential long off that level. We never broke the trend line. We continued to move lower. Then yesterday, everything's time stamped about 1 p.m. Said it is testing that 1612 former support, which is now resistance, as well as the top of the channel. I like that. Remember, I love when I see not one but two well-defined levels. So as such, we could break out here while one more thrust down would still keep the divergences intact. So you had two options: wait for the breakout, or watch it, see if it made a divergent low. That was yesterday about 1 o'clock, and then posted right after that. It did go on to break out. Here's the chart. Boom, nice breakout. And we went up, hit that first target for a quick 4% gain, and showed it, continuing up there. And that was then. So we hit the that 1680 level. Had it coming pulling back, but it's still, this was a bullish pattern. So this is kind of a takeaway from this, and we've come full circle. I'll get to the updated charts in a second. Nice to see this divergence. That plays out for more than just a quick pop. Usually you're going to have a wave, at least a counter trend, a reversal, trend reversal. That's what these divergences I look for. Tops and bottoms. These aren't major tops. They're major tops on a little 60-minute chart, because remember, that's what we're trading here, hourly chart. And you can see all the additional targets. So had it zigzagging there, and that was yesterday. Let's look at today's chart right now. That's it. So here was your breakout right here, an objective long over that downtrend line plus 1612 level, and it played out, went a little higher than the original where I had it pulling back, but pretty much the same thing. I had it going like this, pulling back, going up. And this is a beautiful, just kind of more of a hindsight trade, or maybe a short trade here, because what you can see here, if you take a step back, is a beautiful little type of bull flagging action. You had the downtrend line or price channel right there, pretty well defined price channel. You had positive divergence, which was a catalyst. You had a breakout, and you didn't just limp on through there. You had an impulsive leg up. So this whole thing is called the flagpole. That is a bull flag. So you had that consolidation. That's where I was looking for that zigzag with another leg up, and then right off that 1680, former target, former resistance, now support, you exploded off there. It had a momentum fueled overshoot of my 1778 target, and that's it. Now the flag did project probably up here at about that 184 level, but yeah, that's a pretty big move right there. And you don't always, a flag is just an estimated, you take the flagpole, add it to the low part of the flag, and that gives you your measured move right there. But in this case, we overshot that level and we've come down. And what you want to see on a flagpole or bull flag pattern is the breakout should be impulsive and the move up should be equally impulsive, but we've already now kind of stopped that impulsive buying, so that's probably the end of the run. This is support, but I like to step back and regroup. I love to trade natural gas, but you have to wait for, be patient, wait for the ideal setups, like these, look for divergent lows and then find a nice trend line break, find impulsive breakout like this. We traded it back here. Most of the time these are unofficial trades for a couple reasons. Number one, natural gas is about the most volatile commodity out there. I can think of fewer commodities that move so much so fast. So it's not for most people. A lot of people on the site here I know coming in don't have a lot of trading experience, and you can get clobbered trading natural gas. You have to be fast. You have to have a pretty high risk tolerance, loss allowance, and the other thing too is I like to trade the futures because a lot of times these targets and these breakouts occur off hours, whereas the ETNs that you're trapped in, your big move can come overnight. Let's say it's 7:30 in the morning, the final targets hit, and natural gas futures start reversing. By the time the market opens and you have UNG or UGAS, too late. You already missed out. You've given back most of your profits because the move, the target was hit in the 2 hours before the stock market opened. So that's what makes it kind of tough to trade those ETNs. But with that being said, I did mention UGAS and UNG as a trading proxy for this yesterday. So that's it. Crude oil. Somebody asked me yesterday about crude, and I said, look, it is at or near the support. I had to redo this chart because the futures just rolled. There's a pretty important reaction low back here from late March. We hit it again. We do have bullish divergence. I can tell you right now, there's bullish divergence. Crude has obviously supply problems right now. They're just, planes aren't flying, cars aren't driving, and so there's been a glut of crude oil right now. They're even running into storage problems. However, I'm going to tell you there's a potential setup right there. You have bullish divergence. You had a break right here, so I'm going to show you what I think. 25.40-ish is that pretty important support level. A lot of traders will be watching that. That was that reaction low. We tested it there successfully, tested again, broke below it. So now if we can reverse, this will be what we call a bear trap, meaning we broke support, shorts pile in thinking, okay, crude's going to go down. The CME is already, or CBOE, or no, CME is already talking about pricing their futures to accept negative crude prices because there's so much crude. The headlines have said lately that some producers might have to pay for people to take crude off their hands because there's nowhere to store it. The tankers are full, the oil vats are full, etc. So that's the headlines. But when you read that, you get super doom and gloom. All I can tell you right now is if it can pop up here, I'm not sure if just a move back over 29.40 will trigger an explosive rally. There's still some resistance to contend with right here. So it is possible. So you could take it. Look, you could take it if you regain 29.40. Just don't fall in love with it. Keep a relatively tight stop. Maybe add to it if it can break above this recent high right here. Otherwise, be aware. Again, crude definitely has some supply-demand issues right now. And, I think if the stock market can rally next week, can build on this week's gains, what that's going to tell us is the masses must believe that this whole corona thing's going away, that the social distancing measures are going to be relaxed. If you see more and more states remove the stay-at-home orders, then at least the mindset of traders are probably going to be, oh, well, crude should rally because now people are going to start driving to work and commuting again. More planes are going to start flying, so therefore demand for crude is going to increase. So there's a potential for an explosive rally. That's why I'm covering it here. And you want to see targets? Well, there's the first one, 26.85. There's the second target, 29.50, and there's a potential third target. It can go the other way, but like the stock market and everything else I've been talking about risk reward. I think the risk right now, the risk reward is skewed to the long side despite the problems crude has. In other words, I can see easily a 25% explosive short covering rally before I see crude dropping another 25%. Again, crude, all the talk of producers paying people to take crude off their hands, I don't think it's going to happen. Negative crude prices, just because the CME is preparing for that, doesn't mean it's going to happen. They're just, preparing ahead of time, because that's when you have to do those kind of things. So again, crude's at 25 bucks a barrel. So yeah, again, that's where I think the risk is right now, is more to being short and getting caught in a short squeeze than trying to short it here at 25, thinking it's going to go down to 10 bucks a barrel. So we'll leave it there. Wrap the video up here, and I think that's everything I wanted to cover. Yeah, let me get this out to you guys before the close today. It's almost 3 o'clock right now. This may be my last video for the week. There's not much else that I can cover on the broad market or anything else. So I'll leave it here, and I'll wish you all a happy and healthy and safe weekend. And if I see anything big before the close, I will get it out to you, whether it's in a video or just a few static charts. I'll try to get those up for you guys. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.